Hi everyone. I would like to welcome you all to the tutorial of accounting for leases lesson. So since we couldn't do the physical tutorial for this leases chapter 12, we thought of doing a recording, and then after completing your lesson at the classroom by your lecturers, you can refer to this tutorial in order to do more questions, right? Before moving on to the questions under leases, I would like to quickly run through these slides. So, I'm pretty sure you have completed these slides, but we'll quickly run through it. Then it would be easy for us to do the questions, right? I'll just summarize, right? I'll just summarize what is coming under this lesson. So, our lesson is leases. What is the applicable accounting standard? SLFRS 16. And you need to remember one thing. There are two parties of a lease contract, right? The first party is lessee. Lessee, the party who obtains the lease. The party who obtains the lease. And the second party is lessor, right? The party who gives the underlying contract. Let me go to the slide as well. See, an entity that obtains the lease. That means right to use the underlying asset. And lessor means who provides the right to use an underlying asset. Okay. So let's say lessor has a building. Lessor has a building. Now, lessee needs to have a building but doesn't have a building. Now, what can we do is this lessee can pay a consideration. Consideration means what? A lease rental to the lessor, and then lessor will give the right to right to use the building, right to use the building to lessee. So lessee is paying a consideration to the lessor. Lessor is giving the right to use the building to the lessee. This is what happens normally in a lease contract, right? Okay. Now, when it comes to leases, there are two types, as you have discussed, right? Finance lease and operating lease. Now, when it comes to lessee, do we consider types of leases like that? Finance lease or operating lease, do we consider those two types? No. All the leases are the same. All the leases are the same for lessee. So you call lessee call a lease as a lease. Normally, it's a lease. Lessee doesn't have to consider whether it is an operating lease or finance lease. But when it comes to lessor, leases are two types, right? When it comes to lessor, there are two types. What are those two types? Finance lease. It can be a finance lease or it can be an operating lease that you know, right? Okay, so if I just go to the relevant slide here, slide number 33. If you can see, we have categorized finance and operating lease. That is for lessor, not for lessee. So finance lease means what? A lease that transfers substantially all risks and rewards incidental to the ownership of the asset. Now, in a finance lease, lessor will transfer all risks and rewards to lessee with regards to the underlying asset, right? You will understand these things in later, and I think you already know these things because you have discussed in the lecture. But when it comes to operating lease that does not transfer substantially all risks and rewards. In this operating lease, lessor does not transfer all risks and rewards to lessee. Lessor is keeping all these, not all these, substantial risks and rewards to lessor, right? Not transferring, but finance lease, risks and rewards will be transferred to lessee. Okay. And I think you have discussed all these examples as well. So what are the examples? Why do we call passing risks and rewards to lessee? If the transfer of the underlying asset, that means ownership. Ownership of the underlying asset will be transferred to the lessee. Let's say it's a 5 years lease contract. At the end of fifth year, ownership of the underlying asset, that means if the lease is about a building, ownership of the building will be transferred to lessee. Then is that a finance lease or an operating lease? It is a finance lease. Why? Ownership is getting transferred, right? Likewise, this is one example. I think you have discussed these examples. So operating lease and finance lease. So accounting part. Now we are talking about accounting now. When it comes to accounting, in lessee's books, there's a particular way of doing the accounting part. All the leases are the same. And when it comes to lessor's books, there's a particular way of doing the accounting. And finance lease, it has a separate accounting mechanism. And operating lease, it is different, right? So these three things you need to remember. These three things you need to understand. Right. Now, let's move on to lessee. When it comes to lessee, there are two things you need to recognize and measure. There are two things you need to recognize and measure. What is the first one? Lease liability. Why? Now the lessee has obtained a right to use a particular asset, right? Lessee has obtained a right, right to use a particular asset. Now, in that case, lessee can't get that right to use the asset free of charge, no? Right? Lessee has to pay consideration over a period of time, over the lease period. So, in that case, what happens? There's a lease liability. And the other one, a right of use asset. What is that? Now, I told you, lessee is obtaining a right to use the asset. That right to use the asset is an asset. It is an asset, right? It is a right to use a particular asset that becomes an asset. So these two things you need to recognize and measure when it comes to lessee. What about lessor? What about lessor? When it comes to lessor, there are two things. But when it comes to finance and operating lease, these are getting changed. That's why I'm not explaining it here. I'll explain with the question. Right. Now let's take, what do you mean by a lease liability? What is included in a lease liability? Right. Now, if a question says calculate the initial lease liability as at a particular date, you need to know the components coming under lease liability. What are those? Let's go to the slides. Right, slide number 40. This slide fully includes all the lease, all the payments, all the components coming under lease liability. Lease liability එක තියෙන්නේ මොනවද? There are 5 elements. Let's summarize quickly. What are the 5 elements? First one, fixed payments. Just remember in a summarized way like this. Fixed payments. Throughout the lease period, if you have, let's say there are 5 years, if you have to pay lease rentals monthly and that amount is fixed, those fixed payments. And then if there are any variable payments to be made, that means your value to be paid will be changed, maybe based on an index, right? It is not the exact same value. There will be changes to the value, but you have to pay. Those are variable payments. And third one, what is the third one? Residual value guarantees. So we can say guaranteed residual value. At the end of the lease term, lessee is promising the lessor that he or she will pay a fixed or that promised amount, right? Guaranteed. That amount is guaranteed. Lessee will pay this amount to the lessor at the end of the period, right? Guaranteed residual value. Number 4, Excise price of a purchase option. If the lessee is having the purchase option of the underlying asset, let's say at the end of 5th year, at the end of the lease term, this lessee is having the purchase option. At that time, to exercise that option, needs to pay an amount. That amount, exercise price of the purchase option. Number 5, penalties for terminating the lease. If the lessee is terminating the lease, and a penalty will have to be paid to the lessor, that amount, right? So these are the 5 things. Remember, fixed payments, variable payments, guaranteed residual value, exercise price of a purchase option, penalties for terminating the lease. So these are the things coming under lease liability. Now, what happens is you can write down these 5 items and put the values like this. Let's say here 1000, here 200 likewise as an example. So I'm putting these random values. So you're taking the total, right? You're taking the totals. So another important thing, let's say fixed amount. You have to pay in first year like this. I'll take it with years in order to show you. Let's say this is a 3-year lease period. 3-year lease period. Lease period is 3 years. Fixed payments 100, 100, 100 for 3 years. It should be fixed. Variable, here 80, here 70, here 60. Guaranteed residual value. Guaranteed residual value is paid at the end of the lease term. No. So it can't be first or second. It should be the last year. It should be 3rd year if it is a 3-year lease period. Let's say 20. Exercise price of a purchase option. Let's say 10. Penalties. Let's say 5. Likewise. Then you need to take the total, right? And yearly period wise, you are taking the total. Then what? Now, 180 will be paid at the end of or during first year. 170 will be paid in the second year. 195 will be paid in the 3rd year. Now, we can't just take the total of these values as 545. No. Why? Time value of money. Mudale Kali Nagaya. Because of that, we need to do what? We need to discount these things. Discount these values. How can we discount? There are 2 things you can use. In the lease agreement, if the interest rate implicit in the lease, that if the lease interest rate implicit in the lease is determinable, if you can clearly find that interest rate, you can take it. If not, what? If not, using the lessee's incremental borrowing cost. So if you have the implicit lease interest rate, you can use it. If you do not have it, then you can take lessee's incremental borrowing rate. These things will be given in the question, right? So you can use, let's say the implicit interest rate is 20%. Then what? You need to take the discount factors, right? I think you know how to take discount factors. You take the discount factors and then you take the present value. We'll see how to take the discount factors, how to take the present value in the question. But remember, you have to take the present value. So that is what? This is initial measurement of the lease liability. Initial measurement of the lease liability. Answer will be here. Okay, so this is how you take lease liability. And what about right of use asset? Right of use asset. If you have to take right of use asset, how do you take this? You can refer to slide number 13, right? You have to take 4 things. You have to take 4 things. So in the lease liability, there are 5 elements you need to remember. Here you need to remember 4 elements. What is the first one? First one coming under right of use asset is the initial measurement of the lease liability. So you have computed your lease liability now. using these 5 components. Now you have to take the answer to here. Initial measurement of the lease liability, that is the first component of your right, of your asset. And then what? You need to add any down payments made. Now in a lease, you may have paid initial payments. That means down payments to your lessor. You have to take those down payments as well. Not only that, you need to take initial direct cost. Sometimes you have incurred legal charges on behalf of the lease. So initial direct cost, you need to take those things as well. And the last one is what? You have to take the present value of dismantling cost. Dismantling or restoring the site. I'm just taking a summary thing of this fourth point, right? You have discussed these things. So if the lessee is liable to dismantle the plant, let's say a lessee has obtained a plant under a lease agreement. At the end of the useful lifetime, lessee is liable to dismantle it, or lessee is liable to restore the site. In that case, what happens? You have to take that present value of the future cost. අනාගතයේනේ මේක dismantle කරන්නේ. අනාගතයේ තමයි site එක restore කරන්නේ. You have to take the present value. PP වගේමයි. You have to take the present value of those. So these are the 4 components coming under right of use asset. So initial measurement of the lease liability plus, down payment plus, initial direct cost plus, present value of dismantling or restoring the site. Right? So basically, you need to remember this thing, lease liability and right of use asset. Okay. Now what? Finance lease. I'm moving to lessor side. Now, can you remember finance lease? When it comes to finance lease, similar to lessee, right? Similar to lessee, finance lease, lessor has 2 things to understand, 2 things to recognize and measure. What is the first one? Lease receivable. That is, the lessee has to pay amounts to the lessor. No? So from lessor side, those amounts are receivables. So lease receivables, right? That is the first one. Okay. Likewise, you need to remember there are things to recognize and measure coming under lessee and lessor. Okay, so now I have gone through the important things. Now we'll discuss how to do questions. By looking at the summarized version, how to do the questions. Right. So I have a question. Question number 1 is this. Okay, hope you can see clearly. We'll read the question and then we'll move on to the answer. A lessee enters into a leasing agreement, right? Leasing agreement on 1st April 2022 for equipment. What is the commencement date? Commencement date is 1st April 2022. What is the underlying asset? Underlying asset is this equipment. The lease requires an initial payment of 50,000. That means this lessee has to pay a down payment of 50,000. Annual rental of 40,000 payable at the end of each year starting from 31st March 2023. So annual rental is 40,000. The primary period of the lease is 4 years. That means the lease term is 4 years, right? After the end of primary period, the lessee has the right to extend the lease indefinitely on payment of a nominal annual rental. Now, looking at this clause, you need to remember this thing. What is that? You need to remember finance lease and operating lease, right? Now, when it comes to finance lease and operating lease, there are 2 things. That means there are 2 categories. There are different situations and examples where you can categorize a lease under finance or operating lease. Now, in this situation, at the end of the after the end of primary period, lessee has the right to extend the lease indefinitely on payment of a nominal annual rental means substantially risks and rewards will be passed to the lessee. In that case, what happens? Is this an operating lease or finance lease? This will become a finance lease from lessor's side. The interest rate implicit in the lease is given 15%, and then the present value annuity factor at the rate for the fourth year is 2.855. That present value annuity factor is given. The lessee believes that the equipment can be used for 4 years and will have no scrap value at the end of that period. Lessee depreciates assets of this type using straight line basis. Both the lessee and lessor have accounting periods ending 31st March. Now, what is required? Record these transactions in the lessee's and lessor's books of accounts for the year ended 31st March 2023 and the extracts of the financial statements. Now, we have to do accounting for both lessee and lessor's books. Right. Now, I will do first lessee's books, right? Lessee's books. Okay. Now, coming under lessee's books, we have to recognize how many things? 2 things. What are those? Lease liability and right of use asset. Shall we quickly take lease liability? Right? The first one is lease liability. Okay, so in order to take lease liabilities, there are how many items in the lease liability? There are 5 items, right? These are the 5 items. Now, tell me, like think about the answers now. You can't tell me, no? So what are the things coming under the lease liability? What are the payments? Do we have fixed payments? In this lease agreement, do we have fixed payments? Yes, right? We have fixed payments. What is the fixed payment? Annual rental of 40,000 payable at the end of the year. For how many years? For 4 years. Okay. So we'll take 1, 2, 3, 4. Those are the years. I will write it like this. Fixed payments. How much? 40,000. 40,000, 40,000, 40,000 and 40,000. It's the same. Do we have variable payments? No, right? We don't have. Do we have guaranteed residual values given here? No, we didn't say. Exercise price of a purchase option? Penalties for terminating the lease? No. So only payment is 40,000 thing. Now, normally, if in the question, let's say this discount factor is not given, annuity factor is not given, then what to do? We have been given the implicit interest rate that is 15%. Now, after taking all the payments, now this is the only payment we have, we can compute the discounting factor at, what's the rate? 15%. Discounting factor at 15%. How can we take the discounting factor? Remember the formula, right? 1 divided by, within brackets, 1 plus R. R means 0.515, that is 15%, close brackets, to the power of number of years. Year 1. This is the discounting factor. You can take the same discounting factor. Since this is an Excel, I am copy paste it, right? So you can take it. Let's say I'm taking the discounting factor for 3 decimals, right? So likewise, you are taking the discounting factor. And then do what? You take the present value. How do you take the present value? Payment multiplied by the discount factor. Right. Okay. And then what? You can take the initial measurement of the lease liability, right? You are taking the initial measurement of the lease liability. How can we take it? You can take the total of the present values. This is similar to taking net present value, right? Okay. This is what the value is. These are in rupees, so thousands. These are in rupees, right? We need to mention that definitely. 114,199. 199. Okay, now let's move on to the question. In the question, it says the present value of annuity factor at the rate of fourth year is 2.855. Annuity factor එක අපි use කරන්නේ කොයි වගේ වෙලාවකද? වසර 4ටම for all 4 years if the payment value is the same. Now දැන් මේ අවුරුදු 4ෙම අපේ payment value එක සමානයිනේ 40,000. Our payment value, fixed payment value is the same for all 4 years. In that case, instead of computing discount factors for all 4 years separately like this, මෙහෙම කල්කනොට වඩා you can take the payment that is 40,000, that is fixed. You can take the annuity factor. Now the annuity factor is given 2.855. 2.855. So instead of taking several discount factors for many years, you can easily take this annuity factor and then you can multiply that fixed amount as well. What is the amount? We are getting 140,000, 114,200. So it is almost the same. So you can see, right? It is almost the same. So this is why I computed the value using both ways. You need to know both. So if you have the annuity factor, you can just multiply and take the value. And if you don't have the annuity factor given, you will have to take the discounting factors like this and take the present value. Your total initial measurement of the lease liability will be this value. So for this purpose, for this question, I'll go with 114,200, right? Because it is the most correct answer why we have been given the discounting annuity factor, right? So this is the lease liability value. Lease liability at the as at the beginning, 1st April 2022, initial lease liability. And what? We have to consider now right of use asset as at 1st April 2022, initial value of the right of use asset. Now, what are the components? There are 4 components coming under ROU asset. What is the first one? Initial measurement of the lease liability, as we discussed. Initial measurement of the lease liability. What is that value? That value is 114,200. The amount we computed in the part 1. And then what? If you have any down payments, you need to take. Do we have a down payment in the question? Yes, 50,000 down payment. So you have to take 50,000, right? Do we have any initial direct expenses given? No, right? There are no any initial payments, direct payments. Do we have a dismantling cost or restoring the site cost? Do we have to take the present value of it? No, those things are not given. So we have only the initial measurement of the lease liability and the down payment. You can take the total. See, this is right of use asset at the asset 1st April 2022. This is the answer. Okay. Now what? Now we have to, these are the initial lease liability and right of use asset. Now in the question, we had to record this transaction in the books of lessee and lessor. Still, we are doing lessee side. Shall we record this transaction in ledger accounts? Okay. Now I'll be quickly drawing a simple T account. Right, like this. I will take three accounts, three ledger accounts. Okay, the first one is I need one ledger account for lease liability, of course. And then I need another one for what? Right of use asset. Right of use asset. And what? As the lessee, we need to pay what? On behalf of this lease liability, we need to pay lease interest. I will take another ledger account for lease interest as well. So let's record this. First of all, the lease liability. Lease liability is 114,200. What should be written here? Right of use asset. I will debit this amount to right of use asset. Why? This is the first component. This is lease liability. I hope this is clear. Right of use asset debit, lease liability credit. And then the down payment. Down payment is already paid or not? This is already paid. Then what about cash? Cash credit. And then debit goes to where? Debit is 50,000. This is cash. Okay. And then what? These are the things to be recorded, right? Okay. Now, okay. So after recording the right of use asset and the lease liability in these two accounts, now the next step is what? Now I told you during this period, the lessee has to pay lease interest as well. Now, how this lessee is paying lease interest to lessor, how this lessee is computing it, we have to take the lease liability. Now, in this year, the lease liability is 114,200. This is the amount we computed. Now, out of this 114,200, you have to take 15%. That is the lease interest. So that is 17,130. That is the lease interest. So you can take lease interest. You can, right? You can show it lease interest 17,130. And then lease interest account. You have the lease interest account. There you can do what? This is an expense account. Expense account means debit 17,130. Here you can write lease liability. So I think you are clear how to record this lease interest in two accounts. Lease interest account debit, and you are crediting that interest account to lease liability. This is the first step, right? Then what? During this period, there will be lease payments. Why? You have to pay 40,000 each year. You have to pay 40,000 each year. When you pay lease payments, when you pay lease rentals, what will happen to your lease liability? Your lease liability will be reduced. So what happens? When you pay your lease rentals, your cash credit and then your lease liability debit 40,000. These are the lease and these are the transactions. First of all, you need to record the lease liability, that is the 114,200, that amount you computed, initial lease liability. And then you need to record right of use asset. The components are there, 114 and 50,000 you need to record. After that, you need to do what? You need to pay lease. Pay means identify the lease interest. So how can we compute lease interest from the lease liability? You are taking 15%, that is credited to lease liability, debited to lease interest account, right? And the next one is you have to pay lease rentals. When you pay cash credit, lease liability debit, 40,000 debit. Okay. Now what? That's all for 1 year. Now we can balance the first year, right? So I'll take the total 131,330. Here also 131,330. What is the balance? Balance carried down. 91,330. Balance brought forward. 91,330. Okay. Okay, this is at the end of first year. Okay. And then what happens? Right of use asset. Do we do any changes? No. It's the same. Okay. It's the same. So 164, 200, 164, 200. This is balance carried down. This is balance brought forward. There are no changes happening to right of use asset. It will be continued till the year end. Year end means lease period end. Okay, this is how you record the initial transactions. So in the second year also you can continue the same thing, right? You second year also you can continue the same thing. Let's do one second year as well. Now in the second year, your lease liability is this. Now you need to compute lease interest. Lease interest is 15%. You take 15% here. And you need to pay your lease rentals. That is 40,000. You have to pay that. Then again, take in the total. Take in the total 105,030 and the balance. This is balance carried down, and then you have balance brought forward, that is 65,030. Again, you have the lease rent. Now second year gone, right? Second years are gone. Now you this lease rent interest, you can record it here. Now in the first year, this is a P&L account. There are no opening or closing balances for a P&L account. 17,130, 17,130 here. This goes to where? P&L. P&L. First year gone. Second year, again, you need to record it. 107, not 700, 17,130, 13,700. The second year interest. See, second year interest. And then again, it's the same. Again, it goes to second year P&L. Right? 2 years down. Third year again, I will compute lease interest. 65,000 multiplied by 15%. This is the lease interest. Let's go here. Lease liability from the lease liability account. Third year interest is 9,755. And then again, I'm taking the balances. 9,755, 9,755 P&L. And then third year also, you are paying cash, right? Cash, that is 40,000. And then again, I'm balancing off for the third year. How can we balance off? 74,785, 74,785. And then balance carried down is, balance carried down is what? 34,785. So balance brought forward at the end of third year, 34,785. Right? Now 3 years done. Fourth year. This should be the last year, right? Shall we compute lease interest? Lease interest again. How can we take? 34,785 multiplied by 15%. The lease interest is 5,218. That means lease interest for the fourth year is 5,218. I'm taking the total. 5,218. 5,218. This goes to P&L. Okay. Again, fourth year, you have to pay what? You have to pay 40,000 lease rentals. Then what? Shall we take the totals? Okay, so you can see because we took annuity factors and we limited our decimals to 3 places, 3 decimals. Because of this, we have 3 rupees difference. If not, this should be exactly 40,000, right? So I'll take it as 40,000, okay? 40,000. I'm ignoring 3 rupees because that is not material at all. So do we have a balance carried down or balance brought forward after fourth year? No, we can't have. Why? After fourth year, lease period is completed. So this is how your lease liability is getting zero at the end of fourth year, right? So your right of use asset, there are no changes. It is going to continue. And then your lease interest. Now for first year, second year, third year, and fourth year. Not only this, you need to do what? You need to depreciate this right of use asset as well. You need to depreciate this right of use asset. How can we depreciate your right of use asset? There's a condition, right? There's a condition. Let's move on to your slide. What is the condition? You need to remember when you are depreciating your right of use asset. Slide number 20. Whether the lease transfers ownership of the underlying asset to the lessee by the end of the period. Now tell me, by looking at the question, what happens? Right? This says, after the end of the primary period, the lessee has the right to extend the lease indefinitely on payment of a nominal annual rental. And also, now, if you read the second condition, whether the cost of the right of use asset reflects that the lessee will exercise a purchase option as well. Now, when you see these two conditions, with this scenario in this question number 2, you can say, yes, right? The ownership will be transferred because the lessee is trying to extend the lease period for an indefinite period, and there will be excise option most probably. So by looking at this condition, you can decide yes. Your answer will be yes. And then what? You have to depreciate your right of use asset using the useful life. Useful life. Now, when you take the useful life of this asset, that means the underlying asset means equipment, it is given, right? The lessee believes that the equipment can be used for 4 years. So when you depreciate, what happens? Let's compute depreciation here. RES, depreciation as a working. Your right of use asset value, that means similar to PPE or cost. Your right of use asset value is 164,200. How many years? What is the, now we have to take what? We have to take the useful life, no? So useful life, how many years? 4 years. Then what is the depreciation value? 164,200 divided by 4 years. That is 41,050. This is annual depreciation. So for 4 years, you can continue the same value because the depreciation is on straight line basis. All right. Now with that, I'll be teaching you how to do a lease schedule. Now remember, when it comes to lessee side, first of all you had to do this lease liability, compute lease liability, and using the initial measurement of the lease liability and adding other three components like down payments, likewise initial direct cost, present value of dismantling cost, you need to take the right of use asset. And this is how you record the transactions in the ledger account. First, you record lease liability and then a right of use asset, and then annually your lease interest, and then your lease payments, and then you can balance off. Likewise, you can continue until the lease period ends. And also, you need to depreciate your asset based on the two criteria given, whether the ownership of the underlying asset will be transferred, right? Likewise, you need to consider those two conditions and decide how to do the depreciation. Now, how to create the lease schedule? How to create the lease schedule for this? Right? Lessee side. I will take years as a column, and then I will take opening balance, and what? I will take interest. I will take payment. Payment. I will take the capital amount paid. I will take the capital amount paid. I will take the closing balance. And then again, I can take what? Now remember, as you have learned, your lease liability. When you show a liability in the statement of financial position, you can't just record the full lease liability and the non-current liability. You need to understand the non-current liability portion and the current portion separately. Okay, so that's why in order to do the extracts of the financial statements clearly, I can understand non-current liability and current liability. Current liability, right? Like this. So shall we fill this now? How many years do we have? 1, 2, 3, 4. What is the opening balance? Opening balance of the lease liability, right? Opening balance of the lease liability. This is 114,200. How to compute interest? From the lease liability, 15%. 17,130. Am I correct? Yes. This is what we computed. 17,130. Okay. Payment. I'll put minus as well because that is a payment. 40,000. Okay. No. If you are not that much clear about that, I'll take normal 40,000. Then what? During the first year, your payment is 40,000. This is the full amount you pay to your lessor. You are paying 17,130 interest. Then what is the capital amount you are paying? 40,000 minus 17,130. Then what is your closing balance? Your closing balance is to your opening balance, you had to add your interest, but you paid 40,000 payment. To the opening balance, you had to add your interest and you are paying all together, capital and interest all together. You are paying 40,000. This is your closing balance. See whether it is correct. 91,330. It is correct. Balance brought forward, balance carried down is 91,330. Right? We'll come to this non-current liability and current liability later. Now, second year. Second year, what is the opening balance? Second year opening balance is the closing balance of last year. Closing balance of last year means 91,330. What is the interest of the second year? 91,330 multiplied by 15%. Are we correct? Yes. 13,700 previously we computed. What is the payment? 40,000. What is the capital amount we paid? Even though we paid 40,000, out of the 40,000, 13,700 was your interest. Then what is your capital? 26,301. What is your closing balance? Opening balance, you added interest, but you paid your payment. 65,030. See, 65,030. It's the same. Likewise, you can continue till the end. So again, opening balance becomes the closing balance of the previous year. Since this is an Excel, I can copy paste the links, right? Like this. See, again, there will be a balance. There can't be a balance, it should be 0. For this purpose, for your understanding purpose, I'm making it 0. But because of the decimals, we are getting slight differences. Right. Now we'll fill non-current liability and current liability portion. What is that? Now, at the end of first year, what is your current liability? Current liability means the amount that you will be paying, right? What is that? Think about it. Amount that you will be paying during next 12 months. During next 12 months. So when you in the first year, at the end of first year, your full closing liability balance would be 91,330. But in the second year, out of 91,330, you will be paying 26,301. I hope this is clear. At the end of first year, your total liability was 91,330. But in the second year, out of 91,000 thing, you will be paying 26,301. So now think about this. At the end of first year, what is your current liability? What would be the lease capital you will be paying during next year, next 12 months? That is 26,301. See, 26,301. So if the total liability is 91,330 and your current liability is 26,301, your non-current liability would be the difference between these two, 61,029. Same goes to the second year. At the end of second year, what would be the current liability? The amount, the capital amount that you will be paying in the third year. That is 30,000. Then your non-current liability would be difference between 65 and 30, which is 34. Okay. And when it comes to the third year, your current liability would be the amount that you will be paying in the fourth year. Amount means the capital amount, 34. If your total liability is 34,784 and your current liability is 34,782, you don't have a non-current liability. Practically, you can't have a non-current liability. This 2 is coming because of the decimal issues. I'll make it 0. Why? Now, at the end of third year, you don't have a non-current liability. Why? Everything, the balance will be paid in the fourth year. Because after 4 years, there's no lease agreement. Right? So, this is how it goes. I hope you are clear. Shall we add right of use asset as well? This is a summary. If you can do this summary, you can answer any lease question, right? So what is at the end of first year, right of use asset? Sorry, right of use asset. What is the value of right of use asset? This value, 164,200. At the end of second year, same. At the end of third year, same. At the end of fourth year, the same, right? And then, what is the depreciation? Depreciation, we have computed 41,050. It would be the same. It would be the same. What would be the accumulated depreciation? Those are very simple things, right? You have learned in PPE. What is accumulated depreciation? First year, 41,050, and then both years, and then all 3 years values, 41,050 into 3, and then all total value. Okay, this is accumulated depreciation. Now, if you can prepare this lease schedule, then you can very clearly answer all the questions, right? And also, it will be very easy to prepare the extracts of the financial statements as well. Shall we quickly prepare the extracts of the financial statements? There are two, no? What are those? Statement of profit or loss and other comprehensive income, and the statement of financial position, right? So this is extracts of the statement of profit or loss and other comprehensive income. The first one, you need to know, you have to pay what? You have to pay lease interest. Yes, lease interest. What is that expense for the first year? We are preparing this for what? For the year ended, we had to put the period as well. 31st March 2023. That means for 1 year, right? The first year. What is the lease interest? See, you can look at this table, or if you have the ledger accounts, you can refer to your ledger accounts. 17,130. Your lease interest. Not only that, what is your depreciation? You have another expense. What is your depreciation? See, 41,050. This is your depreciation. Shall we quickly extracts of the statement of financial position? Statement of financial position as at 31st March 2023. We'll quickly, yes. Okay. Now here, what? First one, you have right of use asset. Right of use asset. You need to show right of use asset separately from the PPE. Now you have an equipment. We'll show it like this. Normally we are using a separate note, but for this extract, this is okay. What is the cost? Now you can write, right? Cost, accumulated depreciation, and net value over the carrying amount. What is the cost of the equipment? Right of use asset, 164,200. Accumulated depreciation, 41,050. Carrying amount, cost minus accumulated depreciation. That's it. Right? Non-current liabilities. You have non-current liabilities, right? On the liabilities side. And then current liabilities. Non-current liability, what is that? Lease liability. Here again, lease liability. What is a non-current liability at the end of first year? See, we have computed it. 65,029. Right? Current liability. At the end of the first year. 26,301. So this is how basically you compute lease liability, you compute right of use asset, you do the ledger accounts if required, and you do the lease schedule, and then prepare the extracts of the financial statements. So this is a complete one. All the elements are there in lessee's books. Okay. Now, next one, we'll move on to what? We'll move on to lessor's books. Okay. Okay, so when it comes to lessor's books, as I mentioned earlier, before you record your transactions in the lessor's books, you need to decide whether a lease is a finance lease or operating lease, right? As we discussed. Now, in this case, this is what? Finance lease or operating lease? This is a finance lease, not an operating lease. Now, in that case, if it is a finance lease, in that case, you need to identify net investment. You need to identify net investment. Right, let's go to the slides again. What is this? Net investments. Now, if you go to your slide number 38, we have discussed net investment and gross investment. Okay, first come to gross investment. What do you mean by gross investment in the lease? Gross investment in the lease means all lease payments you considered plus unguaranteed residual value. If I just simplify this, now before going to net investment, gross investment. Gross investment means lease payments plus what? Lease payments plus unguaranteed residual value. Okay, these are the two components. Now, what is this lease payments? Lease payments means what? Lease payments means, can you remember, when it comes to lessee's books also, we considered 5 types of payments coming under lease liability. 5. Fixed payments, variable payments, guaranteed residual value, exercise price of a purchase option, and penalties for terminating the lease. These are the 5 types of payments we discussed on lease payments, lease liability. All these payments will be considered under lease payments. So lease payment is what? The previously explained all 5 types of payments. Now is that clear to you? Now lessee side also we considered these things. So it directly comes to lease payments here coming under gross investment. Gross investment එකේ lease payment කියන්නේ අපි ලෙසීගේ books වල සටහන් කරනකොට consider කරපු මේ item පහම තමයි. Remember that it's the same. Plus, another important thing is coming unguaranteed residual value. So for lease payments, plus you need to add unguaranteed residual value. This is the thing, right? So this is gross investment. Then how do you take net investment? Gross investment in the lease discounted at the interest rate implicit in the lease. If you can discount these payments, now these 5 plus this unguaranteed residual value, if you can take the present value of all these 6 payments, that is net investment. Gross investment එක ගත්තට පස්සේ ඒක discount කරාට පස්සේ net investment එක ලැබෙනවා. Right? Okay. Now remember that point as well. Right. Let's go to the question now. Now in the question, we have to take the present value, no, net investment, we have to take. In order to take the net investment, we have to take the present value. That means like this. Yearly, we have to identify our payments, right? 1, 2, 3, 4. We have 4 years. There's no changes to that. Now, what are the payments? Now, previously also, we were checking fixed payments, variable payments, and everything. No? So, in this question, if you can remember, we have only the fixed payment. that is 40,000. So it directly comes here. There are no changes. Do we have variable payments? No, right? We don't have variable payments. What else? Do we have guaranteed residual value? No. Do we have excise price? No. Penalties? No. Then only the fixed payments. Now, what is the additional one coming in the net investment? Now, that is unguaranteed residual value. Unguaranteed residual value. In this question, do we have unguaranteed residual value given? No, there's no such value. So if you have one, you can put it here in this last year, similar to guaranteed residual value. Since we don't have, it is 0. Now you can take the total cash flows, that is 40,000. There are no changes. Now what to do? Now you can use the discount factor. What is the rate? At 15%. Previously also you computed this, no? Right? You took the discount factors. You took the present value. Now since there are no additional unguaranteed residual value coming under net investment, it is the same. It is the same value. So because you took 40,000 and then discounted this 40,000. So what? We can directly take this value 114,200 as what? Net investment. So remember, it's not always the case. There can be unguaranteed residual value. If so, you have to take it again and you have to discount it again and take the present value. Since there are no unguaranteed residual value here, net value is also the same. Okay. Right. Now you know how to take the net investment. Now shall we quickly do the ledger accounts? Now in the lessees books also, we have all these ledger accounts prepared. Now we'll quickly prepare the ledger accounts. What are the ledger accounts we need? We need lease receivable account. Lease receivable. Why? If the lessee is recording a lease liability. On the other hand, for the lessor, it is a receivable. That's why lease receivable. And we can identify a temporary account. Temporary account called, what is this underlying asset? It is a equipment. So temporarily we can run equipment, temporary equipment account. Okay. Now what is the first step? We can record this net investment, right? Lease receivable. It is an asset. Asset means debit. 114,200 equipment. Equipment account credit. 114,200. Is that lease receivable? This equipment account is temporary. Okay. Now what? Now, for this lease receivable amount, you are receiving what? You are receiving income. Why? Lessee is paying you lease interest. Now you, from your side, lessor's side, it is an income. So shall we? 114,200 multiplied by 15%. 17,113. What is this? Lease interest. It is not an expense, it is the income. So if you can quickly prepare lease interest income, lease interest income ledger account, you can write. From the lease receivables account, you are getting 17,130. I hope this is clear. Right. What else? Now you recorded the lease receivable. You recorded the lease interest income for the first year. What else? Why? You are receiving lease rentals as well because lessee is paying you rentals. What is that rental value? 40,000. When you receive your lease rentals, what is the double entry? Cash, debit, you receive cash. Your lease receivable account, your asset is getting decreased now. So cash debit, lease receivable credit by 40,000. Shall we quickly balance this off now? Can balance this now. 131. About that. 131, 330. If you balance this amount, balance, carry it down, balance brought forward. It's the same. There are no changes to equipment account. And then this interest, it goes to P&L as an income. 17,130. It goes to P&L as an income. So with that, it's a P&L account. It getting closed for the first year. Second year, so the balance brought forward, it is an asset. Again, second year. Now in this question, you are not required to draw all these ledger accounts for 4 years. But in order to explain you, in order for your understanding, I'm doing all these entries for 4 years, right? In order to show you how these lease receivables, lease liability accounts getting closed after 4 years, right? You don't have to continue this for 4 years, right? It's not necessary, right? 15%. This is the interest income. Again, I can balance this. 105,030. There's a cash payment, cash receipt, that is the second year rental, 40,000. So the balance would be 65,030. Balance carried down, balance brought forward. Again, the balance brought forward is 65,030. Third year. Again, 0.515. You can balance this 74. Second. 74,785. But 40,000 you are receiving. So what's the balance? Balance carried down and then balance brought forward. Fourth year, last year. What's the balance? 34,784. Again, you can compute fourth year lease interest income 0.15. See, I'll take it as 40,000. Now you know, right? This 3 is coming because of the decimal issues. Again, your heart is saying 40,000. There's no balance. So this is how lease receivable account getting zero, getting closed after 4 years, right? Similarly, you can record your lease interest income in the lease interest income account. I'm not showing that to you. Okay, so this is how you, in the lessors books, this is how you record your transactions in the lessors books. Shall we quickly prepare? Now, this is also not required, but I'm showing you. Shall we quickly prepare this lease schedule under lessors books as well? Because that would be easy for you. 1, 2, 3, 4. Opening balance means what? Now, opening balance in the lease receivable, right? Lease receivable. Here it is interest income. Payment, not payment. You are receiving, receipt. Lease rental, receipt. Capital amount, not paid, received. Closing balance of the receivable. Not non-current liability. Now, similar to liability, lease liability. Lease receivable is an asset. Now again, you need to identify current and non-current portion. So, non-current asset and current asset. right? You don't have right of use asset. You don't have depreciation. Clear? Right. Opening balance. Opening balance is what? 114,200. What is the interest? Multiply this by 15%. Right. What is the receipt? 40,000. 40,000 you are receiving. Even though you get 40,000, what is the capital amount you receive? You need to deduct your interest income from the receipt. That means you are getting 22,870 as the capital. What is the closing? Opening balance plus your interest income. Out of that, you are receiving 40,000. So your closing balance is 91,000. This 91,330 becomes the opening balance in the second year. Similar to the previously scheduled, this continues. See, I can copy paste it because of the Excel. So you will see there's no zero, there are no balances here. Closing balance, it should be 0. 2 is coming because of decimal issues. I'll make it 0. Similar to non-current liability and current liability, as we discussed under lessee, we can have this 91,000 divided into non-current and current. Now tell me, total receivable at the end of first year is 91,330. This is the amount you have to receive. Out of this 91,330, during the second year, next year, how much you receive? You receive 301. Then what is that? That is the current asset. That is the amount you will be receiving in the next year. So current asset would be second year capital amount. Then what is a non-current asset? From the total asset, you deduct current asset, that is non-current asset. Similar to that, you can identify. And like this. This is not 2, this should be 0. Okay, so I just went through it because we have already prepared the lease schedule for lessee, and this is about lessor. Right, the final part. Shall we quickly prepare? What? I can copy paste it as well. Shall we quickly prepare the extracts of the statement of financial position and the statement of profit or loss and other comprehensive income? I'll copy paste it since it is easy. Yes. So now is no depreciation. I'll delete the unnecessary parts. Okay. Now here. What should be recorded under profit or loss? Income. Under income, what? Lease interest. Lease interest income. How much is that for the first year? 17,130. Next, in the statement of financial position, we had to talk about the lease receivable, right? So it's an asset, non-current asset, and current asset. Lease receivable. Lease receivables. Again, lease receivables. At the end of first year, we are talking about first year, no? At the end of first year, what is the lease receivable? Current asset, 26,301. Non-current asset, here, 65,030. Okay. So basically, this is how you tackle this question. Now, you will not be asked to prepare lease liability or lease receivable accounts for 4 years for the whole lease term, but I just took your time and explained how this becomes 0 at the end of 4th year, how this becomes 0 at the end of 4th year, right? So basically, this is how you do all these things. lessee's books and lessor's books. Right. Shall we, now that is the end of question 2, shall we quickly check this one as well? This is an easy one. Question number 4. Read that quickly. Binara PLC negotiated to buy a newly constructed building from earlier developers under a lease agreement on 1st January 2022 under the following conditions. The construction of the building was completed and brought to usable condition on 1st July 2022, right? And the lease installments are to be paid monthly for 2 years. Now, the reason why I took this question is, now even though we discussed the whole lessee books and lessor books in the previous question, we took years, no? There were 4 years, 4 lease payments. But practically, if you take a lease rentals are paid monthly, not annually, right? Monthly paying. That's why we took a monthly question as well in order to be more practical. Okay. So installments are to be paid monthly for 2 years. Now tell me, now think about the answer. Monthly for 2 years means how many rentals? 24 rentals, right? 24 months, 24 rentals. During the lease period, Binara PLC is acquiring control over the use of the building. At the end of the lease term, the ownership will not be transferred to the lessee from the lessor. Okay, right. Now, initial deposit is 100,000. Legal fee paid by lessee is 50,000. That is initial direct payments. Installment is 150,000. The interest rate implicit in the lease is 12% per annum. Useful life of the building is 25 years. Right. Now, what is required? Prepare monthly the lease schedule including the below details. All right. Now, you know how to prepare a lease schedule. Now we'll prepare this lease schedule monthly, incorporating these things. Right. So this one, question 2, I'm starting from a new page. Lease schedule. Now tell me, before that, it is not given in this question very clearly, but from which side we are preparing the lease schedule? From which side? Lessee's side, right? Lessee's side. Why? It is right of use asset. It is lease liability. Now, do lessor has right of use assets or lease liabilities? No, they have lease receivables, right? But here, right of use asset, lease liability means from which side? Lessee's side. You need to understand that, lessee's side. Okay, so first of all, we need to include years, not years, months. Right of use asset. Right of use asset, right? Next one, uh, opening balance of the lease liability. Opening balance of lease liability. And then closing balance of the lease liability. Okay, even though it is mentioned closing balance, we know before that it would be easy if we can write interest and then the payment, right? And then the capital amount and then closing balance, right? There's no hard and fast rule to prepare this lease schedule. If you want, you can take lease liability, closing balance of the lease liability at the end. That will be easy. Installment means this payment, right? Installment. Installment. That is the installment to monthly installment, capital amount, interest. All right. We have to mention the depreciation as well. Depreciation as well. Okay. Shall we quickly fill this? Now, how many months are there? There are 24 months. Why? Monthly, 2 years. So, 24. Yes, 24 months are there. We have to compute what? Right of use asset value. Shall we? How to do that? First of all, we have to compute lease liability. That is the first thing. No? Under lease liability, there are 5 components. We are checking whether there are fixed payments, right? Whether there are any fixed payments. What is that? Uh, okay, so the fixed payment. Let's look at the question. The fixed payment is monthly you need to pay 150,000, right? 150,000. Remember, this is monthly. Monthly. We are doing a monthly question. Do we have variable payments or other payments? No, right? Only 150,000 monthly. Now, if you take the normal way we are doing, now we have to take the present value of it. If you take 1, 2, 3, 4, 5, 6, like 24, up until 24, you have to take discount factors, 24 discount factors, right? Now, this is where we can easily take the annuity factor. Annuity factor. Now you know how to use annuity factor, but you don't know how to calculate annuity factor. Obviously, you know because in the tutorials we have computed that, but I'll show you the formula, right? This is why I took this. Now look, looking at this formula, you can compute the annuity factor. Using annuity factor, you can easily take the present value of this fixed payment for 24 months. Okay. Now, how do you take this annuity factor? First of all, what is the interest rate implicit in the lease? 12%. Right. I'll take those information. 12%. Okay. Annuity factor, how do you take? Looking at this one, I'll first compute this one, annuity. Okay, now even we can multiply the annuity value. Annuity is the 150,000. I'll take it as 1. I need to put, since this is an Excel, I need to put equals mark. But if you are using a scientific calculator, no need. So 1 divided by R. R means the rate. Now remember, this interest rate is 12% per annum. Annually 12%. Now, do we compute this, do we do this question annually or monthly? Monthly. In that case, we can't take this per annum rate directly. Annual rate we can't take directly. You need to convert this to a monthly rate. How can we do that? 12% divided by 12. Okay, this is how you do it. That is 100. So that is the first part of the formula. First part of the formula. Second part, what is that? That is 1 minus, I'll open a bracket, 1 divided by, again a bracket, 1 plus R. R means what? Rate. Again, you can't take 12% directly. Divide by 12. Close brackets. And then what? You have to close the fully bracket. 1 plus R. 1 plus R. Okay. To the power T. Time period. So to the power T means how many time period? How many periods? 24. Not 2, not 12, 24. Right? And then what? Again, I cannot close brackets. Okay. Now what? 2 brackets are there. That means the multiplication. You can multiply this. Multiply this. Okay, this is the annuity factor. So if I can take it here, this is the annuity factor. So if you want to take the present value of the lease payments, that means what? 150,000 multiplied by this annuity factor. This is the value. So, what is this? Initial measurement of the lease payments. Initial measurement of the lease payments, you can write it as lease liability because this is what we computed. Initial measurement of the lease liability. So what? This is the value, 3.1 million. So in that case, initial measurement of the lease liability is 3.1 million. Right. Now in that case, we can compute right of use asset as well. Right of use asset. Right? How can we take the right of use asset? We are taking the initial measurement of the lease liability, that is the amount we computed, plus if you have any down payments, if you have any initial direct payments, or if you have the present value of dismantling and site restoration cost, as we discussed, you can include. In the question, do we have any down payments? Of course, initial deposit, 100,000. Initial direct payments, do we have? Of course, legal fees paid by lessee, that is 50,000. Take the total. That is right of use asset. Is that clear? It is right of use asset. Shall we now put these things into the list schedule? I'm putting right of use asset. As I explained you earlier, there are no changes happening to the right of use asset. So you can copy this. Same value will be there. Opening balance of the lease liability, how much? Here, 3.186. How do you compute the lease interest? Monthly. Multiplied by 0.12. You can put a bracket and link it since I'm doing this in Excel. Like this, that value is 31,865. And then the payment is 150,000. Sorry about that, 150,000. Okay, let me remove the decimals. All right, what is the capital amount paid now? Lease rental is 150,000, but out of it, 31,000 is interest. That means capital amount is 118,000. So what is the closing balance? Opening lease liability plus interest minus payment, right? This becomes the opening balance of the next month. Likewise, I can copy these things. I can copy because a second. Right. We'll see whether it comes. Don't worry, I'm just showing you. If you have a question, you won't get 24 months to do the computation. I'm easily doing this because of the Excel, but try to understand the practical scenario of it. Now, can you see? At the end of 24 months, your lease liability became 0. This is what I wanted to show you, right? Your right of use asset the same. Your opening balance, you computed this. Out of that, you computed your lease interest. Remember, I divided it by 12. My payment is 150,000 monthly. Capital payment, you can use that. You can get that. And then the closing balance. Your closing balance becomes the opening balance of the next month. And then again interest, payment, capital, and then closing balance. Likewise, it goes till 0. Okay, this is how you basically take the monthly lease schedule. All right. So with that, we can wind up the session, this recording. I can stop the recording. Now we discussed both lessee and lessor, right? Both lessee and lessor books. How do you keep these records? How do you prepare lease schedule and everything? Okay. So I hope these two questions will help you to understand the lesson better. And if you have issues, you can ask us as well. Thank you.